and welcome back to our monthly market update. My name's Lee and I'm one of the energy analysts here at Northern Gas and Power. Asian demand continues to dictate prices seen across the UK and European markets. A higher level of Asian demand leads to increasing competition for LNG cargoes between the two continents, meaning the UK must pay a premium to the Asian market to attract LNG cargoes to our shores. Norway is one of the largest exporters of gas to the UK. Maintenance at these Norwegian gas fields causes disruptions and limits the total export capacity of the pipelines, thus creating a fear of lack of supply in the UK markets, leading to price increases across both fuels. The UK and European markets continue to rely on gas imports to balance their demand and fill storages heading into the winter months. With the Nord Stream pipelines out of commission, LNG cargoes became a solution to the supply hole, a lack of Russian gas left. The last remnants of summer heatwaves still offer potential. However, focus is now on early cold snaps and market complacency around a continuation of mild winters. Whilst this is most likely the outcome of a 1 in 10 cold winter, would be unprecedented without Russian supply. Middle Eastern tensions coupled with the Russian-Ukraine conflict sparked uncertainty surrounding global supply. Potential disruptions to flows, be it damage to infrastructure or LNG diversions, will move both gas and power curves upwards. Mean UK temperatures were 0.22 degrees below long-term average, heavily influenced by cold Arctic air being pulled south across the UK in early summer. The Met Office issued a yellow weather warning for heavy rain in the south of England, while parts of Scotland could see temperatures well above seasonal norm at 26 degrees in early September. The latter part of the month is likely to be influenced by Atlantic westerly winds, helping keep temperatures around seasonal normal with a mixture of rain and warm periods in places. Average daily Brent oil prices over August 2024 fell 6% compared to July 2024. Prices remained stable over the course of August 2024, only falling 1%. The oil market has reached a holding pattern whilst it eagerly awaits the OPEC Plus policy for October, reaching a within-month high of $82.3 a barrel and a low of $76.05 a barrel. China's development rate continues to be a major driver in the market, with global supply outpacing China's expected demand return, pressuring oil markets down. Forecasts suggest that oil prices could shortly start testing sub $70 a barrel if the current demand and supply picture stays the same, with reports suggesting OPEC are reluctant to cut production again to maintain prices as the price dipped below the $80 a barrel benchmark for a third consecutive month. Oil prices received support at the end of August as tankers were once again targeted by extremist groups in the Middle East, with 3 tankers being attacked over the month of August in the Suez Canal.
In the first half of August, the UK electricity market experienced a moderate price increase across the Winter 24 contract and all subsequent seasons, followed by 4 consecutive sessions of price drops, which began to steadily increase again towards the end of the month. The Winter 24 contract settled at £93.07 per megawatt hour at the end of August, a 6.6% rise from the end of July. The moderate increase in the front season sees the contract jump above the price at which it started the year. We see the market continuing the 2023 era backwardation of the power forward curve. Backwardation, the opposite of contango, refers to future dated contracts delivering at a cheaper cost than the prompt. This impact is most noticeable in the summer. The summer 25 contract trades at 16.5% premium to the summer 26 contract. UK demand averaged 21.7 gigawatts last month, peaking at 24.1 gigawatts. As seasonal average temperatures start to lower, demand has decreased on the back of a lesser requirement for cooling in residential and commercial areas. Wind generation averaged 4.8 gigawatts for August, seasonally normal levels for this time of year. Wind power accounted for an average of 22.2% of last month's demand. Gas was used to generate 6.7 gigawatts of our power to offset any supply shortfall. There is an inverse correlation when comparing gas for power generation with wind speeds. UK demand will now largely be affected by the seasonal change in temperatures. Decrease in temperatures will increase gas heating demand for the UK. Additionally, solar generation is expected to decrease as we head further into winter, creating additional demand for supply elsewhere. The gas forward contract for delivery in winter 24 fluctuated through August. It was a month of 2 halves, with prices rising by over 10 pence per therm at the start of the month and falling by almost 9 pence per therm during the last 2 weeks. The contract peaked at 111.5 pence per therm midway through the month, the highest price seen this year. The winter 24 contract settled at 106.13 pence per therm on the final day of August, a level which saw it gain 2.9 pence per therm since the start of the month. The volatility was replicated across the corresponding curve products, although there were smaller price movements in each of the subsequent 4 seasons. The summer 25 contract ended this month at a 9% premium to the winter 2026 contract, as there is a higher risk premium compared to the later in the curve, due to supply concerns caused by geopolitical tensions. Gas storage across the EU continues to be re-injected at a steady pace, with fullness having reached 92.4% during August, hitting the EU's November target months in advance. Some of August's volatility was caused by the geopolitical developments, including Ukraine's capture of Sudza, home to one of Russia's important gas terminals which supplies Europe. Weak renewable generation and cooler temperatures also drove the bullish sentiment, while strong storage inventories countered supply concerns. UK's total gas demand decreased from an average of 88 mcm per day in July to 74 mcm per day in August, constituting a total reduction of 16%. August 2024 average daily gas demand settling at 74 mcm per day equates to the lowest monthly gas demand in the UK over the last 5 years. Total gas demand through 2024 so far has declined by 6.3% compared to the same time period in 2023. This continues a trend of gradual demand destruction and energy efficiency across both businesses and households. Imports from Norway have decreased by 8% month on month, with 76 mcm per day for August and 83 mcm per day for July. This follows an increase in planned maintenance to the Langeld and Vesterled pipelines, the bulk of which was at the end of August. There was also heavy maintenance planned for the majority of September, particularly at the beginning of the month. LNG storage levels have reduced to 64% capacity, but that level is still strong. In recent months, we have seen historic lows of LNG send-out, and that trend has continued to August. Last month, the UK averaged 6.24 mcm per day of send-out. For comparison, this time last year, send-out was 9.32 mcm per day. UK gas storage sat at 79.4% capacity at the end of August 2024. This is lower than the same time last year. In the month of August, 489 mcm was injected into the system overall, from the start to the end of the month. Both medium-range storage and rough storage increased their fullness compared to the end of August last year, from 66% in 2023 to 79.4% in 2024. EU storage at the end of August closed at 92.3% full, after injecting 50.4 terawatt-hours throughout the month.
The anticipated scenario entails a market that remains range-bound but tentatively bearish. We've observed the establishment of a support level around the lows experienced in mid-February and a price ceiling in early June. Pan-European gas storage remains healthy for the time of the year in the low 90% of capacity, increased renewables output as we approach the windiest period of the year. This can lead to negative spot pricing and propagate weakness down the forward curve. US election. Potential limits on future LNG build-out on energy independence concerns. Although a recent court case has now blocked the pausing of LNG infrastructure build-out, price-led US production cuts. Potential for some downside in cross-Atlantic LNG flows if the mid-February price floor is approached. Increased Asian LNG demand. Prices are now significantly below longer-term oil index contracts and as such are incentivizing spot purchases of LNG from Asia. Thanks for listening to this month's market report. Be sure to find us on LinkedIn for more.